Welcome, one and all, to this episode of the Pre-Market Show. We have an extra special guest. It's probably the first time we've had the same guest back to back, but it's based off of our feedback that we received from you. You really enjoyed our interview with Saheed, and we've been able to bring him right back here for you. So without further ado, we're going to bring on Saheed right after the intro. This interview is pre-recorded due to travel, so we will not be giving away any prizes, but please feel free, as always, to comment in the comment box. We're always looking for feedback and information that you provide to us. It's very, very, very helpful. So without further ado, ladies and gentlemen, we're going to get over to our interview with Saheed. All right, ladies and gentlemen, it's my pleasure to welcome back Saheed. How are you today,
Hello.
my friend? How's everything?
I'm doing very well, Mandela. Thanks for having me back. I'm excited. Thank you so much.
Of course. The viewers really enjoyed the previous episode that we did so much that we said we have to bring you back. It's absolutely a must. So thank you very much.
I know we'd spoken about earnings season, and we were talking a few weeks ago about doing a show because how important it is. So I'm glad we're able to do this right now.
Yes, me as well. And it's very topical because we do have earnings season. We're basically in the midst of earnings season as we speak. We have quite a few earnings that are coming up, this week and next week, and it starts to heat up quite a lot. Can you just give us maybe just a little bit of a indication on right now? Why do you want to build a game plan around earnings season as opposed to, just trading your normal stocks?
Yeah. Earnings season is one of those seasons for traders where some people look at it as noise and it's something they want to avoid. But I think it's one period where you're guaranteed a move. Now, you may not know what direction that move is going to be, but at least you're guaranteed some moves, and you're also guaranteed a little bit of volatility in the market, and so that's why it's important to plan for it. You've seen this week, Mandela. You saw the great moves the banks made. Goldman Sachs, JP Morgan, significant moves in finance, and we're seeing the same. Even just this morning, TSM, reported great earnings. We had ASML report great earnings. So, and then the stock moves. So it's a great opportunity for traders. Many traders are scared of earnings because it can hurt you. But if you plan for it, I think you can always take advantage, if you know what I mean.
Yes, no, and that's exactly what we want to do today. We want to help our viewership get a better grip and almost like a playbook on how to navigate through the earnings season.
Exactly.
So we have here a few beautiful slides that were presented by yourself here. So first question, I guess, is your notes open with research. What does this actually mean? What does this consist of?
Oh, it's very important for earnings season. I think a lot of people listen to the news. They listen to what the chatter is about what's going to happen with a particular stock, but they don't do the needed research. It's kind of twofold, Mandela. I think the first one that is essential is actually to look into whatever you want to trade. What is the market movers' predicted move? So what are the market movers saying the stock is going to move? Because that's something that is priced into the stock price, and you need to know that. The other thing is the report in history. If you're thinking about trading a particular stock, do you know what has happened when they've reported in the last 3 or 4 quarters? how far away
Mhm.
from the market maker's predicted move did the stock move afterwards? What's the actual reporting history? I mean, some stocks tend to be quite aligned. You can tell there's some stocks where most of the time they're within the market movers predicted move. And this is important because it's going to determine, even as an options trader, it's really going to determine your strike price. It's going to determine your sizing and all of that. You need to know how much the stock would move. And there are some stocks. I mean, Nvidia is a great example, right? Where
Yes.
recently the moves haven't been as predicted or as expected. So it's also important to be aware that context is everything. You can't just look at the data and the research and say, oh, the last 3 quarters, Nvidia, blew their earnings out of the water and the stock moved 10%, so it's going to happen now. Context is everything. So I think this is where good research comes in.
Yeah, and I'm glad that you mentioned Nvidia there, because there's always a massive amount of hype and build up into
Correct.
Nvidia earnings, and it's usually later on in earnings season, towards the tail end, oftentimes.
Yeah.
And like you said, you kind of have to know, even though it's let's say Nvidia is expected to move 7%, the last 4 or 5 earnings it's moved less than 2%.
Yeah, absolutely. And I learned this from bitter experience, right? So
Yep.
a novice,
Yep.
I was going into earnings, actually betting on moves, directional moves, right? I was saying, okay, Nvidia going to report great. I'm going to go. The same with Google, the same with Meta. I made bets saying they're going to go in one direction, and they went the other way, regardless of their earnings. So I learned the bitter lesson, and so I tend to try and make trades that are not too directional, and I try to make sure that whatever direction the stock moves, I can profit and my goals are achieved in trading.
That's very good risk manager approach, and I like that because, like you said, you're not sure what's going to actually happen. Even if they do have outstanding earnings, there's no guarantee that the stock price goes up.
Yeah, and when the market makers make a predicted move, it's not in a direction. It's plus or minus. They're just telling you how far, And as an options trader, you can work that out yourself anyway. You just look at the money straddle. So what are the prices? Just add the price of the at the money call and the at the money put. And in that sense, you get how many dollars the stock might move, but you don't know which, and nobody knows. Whoever says they know, it's, don't believe it.
Yeah, I'm glad that you highlighted that as well, because sometimes I think people will assume that it's this sort of magical calculation that only rocket scientists can come up with. But it's a very simple addition equation. And you just make sure you're looking at the right expiration date. But yeah, you're right. Look at the expiration date. So you can easily do it.
You're right. It's a good point. You look at when the earnings, when they're actually reporting earnings, and usually you'll have on your options chain something on that Friday, and then when you look at so it's an approximation, right? And as we know, options prices move. So just even if you've done it, check it again, because the options prices are constantly moving. So it's always good to check and recheck.
Yes, absolutely. So let's unpack the first one. So we talked about market makers predicted move. I know you kind of just explained it a little bit. Do you want to add anything? We do have a slide here on the market makers predicted move, kind of talking about these sort of things.
This exactly illustrates it, and it's good to look at this because sometimes it's good to draw on your chart so you can look at your, whether you use trading view or whatever, right? When you look at the chart, it's always nice to extrapolate on your share where the move might be. And as I said before, it's only about how much it's going to move. This is nothing This is nothing to do with their direction. So it's important to do that. And I always look at this. This is what I look at before I decide my structure. If I'm going to do an iron condor, if I'm going to, as an options trader, whether I'm going to sell a put or sell a covered call, I first of all look at this, because for the most part, I decide if I want things to get assigned or called away. But if I only plain earnings for premium, then these decisions really play into my strike price. But I can explain that a little bit as we go along.
Okay, brilliant. So the next one that we had on here was talking about the history. So you mentioned the second pillar.
Yep.
What are you actually looking for here?
So, and there are some tools out there that could just give you those figures. What you're really looking for is, what were the market makers saying the stock was going to move? So they might have said it was going to be plus or minus 7 or 8%. And sometimes your broker will send you alerts on this. So look out for those. Some people don't realize the broker will normally, a day or two before earnings, just send you an alert saying earnings is on this day, and the market movers are saying it's going to move plus or minus. Sometimes it's a dollar amount, sometimes it's a percentage amount. So what you're trying to look is, how many times has that stock beat in the last quarters, and how much did it move? Was it within the market's line? And so that's essentially what you're trying to make sure. The more it's closer to the full expected move, then the more then I feel a bit more confident to trade based on that. So that's what I'm saying on this one.
Yes, and I think there's two things I wanted to thank you for on this one. Is I do receive notifications from my broker. I think we share a broker, and I wasn't actually following these earnings announcements. So anything that is on your watch list in particular, they will send you. And I got one this morning. So thank you for highlighting that for me.
Yeah,
I think
it's hidden in the corner. It's not very visible, so it's very with IBKR, which we both use, Mandela, as you said. It's not very visible, so it's very easily missed. And when you get 100 notifications on different things, it's easy to ignore.
Yes, it is. But now I know what to look for. It's it changes the game entirely. Okay, so your first tip was plan for both. So you use a strangle. Can you talk us through that just a little bit?
No, that's great. I mean, for one, a strangle is basically selling both sides. So selling a cash secured put and selling a covered call at the same time. And the idea is, say for instance, I have 100 shares of Google, right? So Google is about to report earnings. I've looked at the market moves, and I say to myself, oh, my Google shares are in profit. I would like to capture any upside and then sell my shares and just cash in and make my profit. So what I would do then is I would then sell a covered call on that side. So when Google reports earnings, if the earnings are good, who knows, maybe they spent a lot on their capex is up and the market didn't react badly, then my shares will appreciate. I'll get the premium on the covered call side, and then I'll also then get the capital appreciation, and then my shares could be sold. But then you plan for that. You have to be ready to sell your shares. So the strangle is the case where, as you're selling the covered call, you're also selling a cash secured put. In other words, what I'm saying is, okay, Google is currently, at the moment, I think it's about 370. Now, when they report earnings, if, for instance, the market doesn't like what happens and the share drops to 340, perhaps I've been waiting for an opportunity to buy Google at 340. So at the same time as the covered call, I also have a cash secured put. Now, what I'm doing is I'm also putting expiries for both of these in the week of earnings. And I always suggest to people to try and do all this maybe a month before earnings, because quite often a lot of people think, oh, it's earnings next week. Let's go, let's go, let's go. And they haven't planned. But if you've done all of this like 3 weeks to a month before earnings, then you've got a good period where your trades, particularly as an options trader, and then if it's expiring in the week of earnings, you're taking the full advantage of implied volatility, which means you're getting rich premiums on both sides. But then it also means you could acquire the shares you like cheaper, and you can also sell shares that you've been holding at a profit during earnings. So you can see there's all these multiple opportunities during earnings to really boost your returns. And that's why I think people should really take advantage of them.
Yes, and I'm glad that you are kind of walking us through step by step. It's almost like a course in a way, where these are the ways that you can increase the probability of success.
Absolutely.
And
Absolutely.
as a result, reduce the risks
Absolutely.
of trading earnings, which
Yeah,
I
and
think
it doesn't have to be risky, right? I always say
Yeah.
to people, you size down during earnings. So it's sort of like a larger moves than normal. So don't be tempted to just sort of now go all in because it's earnings season. I think that's the time to size down a little bit just to manage the risk.
Yeah, I think that's key. And with the volatility, there are certain instances where even if you do size down a bit, you could still end up with a good risk to reward. In the sense that, you know, it doesn't necessarily diminish the possible upside.
Yeah, it doesn't.
Necessarily.
You're right. It doesn't diminish the upside, but then manages your risk as well. So you're not putting in everything and then getting, you know, particularly for instance, you know, if you're heavily leveraged, that's a risky position to be in going into earnings as well. So it's best to deleverage in that sense.
Yes. I'm glad that you mentioned that. Okay, so the next question that we have here is, you've noted that for premium only trades, strikes should sit outside the predicted move. So can you explain a little bit as to why that matters and how does that fit in with the strategy?
Yeah, it's really a follow-up from what we've just said. So I mentioned with the Strangle, if you want your shares to be called away, and if you wanted to acquire shares in case it drops, this is just taking on from that. In some cases, you might say, you know what, I'm not ready to sell my Google shares. I just want to hold them longer term, or my allocation sizing is already where it is. I don't want to acquire more shares, but I still want to take advantage. So you would obviously watch out, what is the expected move? And you want to make trades where that expected move is not going to blow through your strike price. So when you do a cash secured put, you're still doing the same cash secured put and the covered call. So you're still trading a Strangle, for instance. But what you're doing is you're making sure the strike prices go beyond where you expect that. So both sides of your trade in the Strangle, or you could even do an iron condor. And you know, the iron condor is one of those directional moves. But if you just want to get premium and not get your account assigned or called away, then you can just use the expected move to choose so that it's outside. And I think that's what this graph is kind of just illustrating, where your prices will be. So in other words, just like you were saying, Mandela, you're reducing the probability of things not going your way.
Yes, and I think that is, in the long term, that is what keeps you in the business of trading.
Capital preservation is the first rule of trading.
It is, and I feel like it's one of the most important. Absolutely,
I agree.
So I wanted to just quickly mention a trade that I did. I had shared it in the group. So there was one trade. There's a company, AEHR. And this was the expected move for this one was 20%. So
Wow.
I use the same sort of strategy. The at the money call, at the money put was telling me that it was going to be about a 20% move, and then I look back and the average move after earnings was approximately 20% again. And just as you set out, looking at the previous moves, the least volatility was 12 to the
Okay.
downside, and the highest was the most recent quarter before this one, which was on April the 7th, and it was a 25% move. So it's basically ticking off the boxes.
Yep.
Real life experience. I did end up getting a call and a put on this particular one, and not sure if you can see that okay,
Yep.
but ended up getting in just before the close. So I got the call and the put for just over $200.
Nice.
And then ended up, I could have sold at the peak. I was kind of holding off because the expiration wasn't until August 7th.
Right.
So I felt like I can give it a little bit of time. But I ended up exiting sort of as it was getting towards 90 on the share price.
Yeah, you got a little bit of IV crush there because
Yes, exactly.
what happens is straight after the earnings and report is out, implied volatility falls sharply a little bit, isn't it? But that's
Yes,
a
it
great
does, it
trade,
does, it does.
Mandela. Nice move.
Thank
And,
you. So,
you
yeah.
clearly did your research, and this is what we're saying to people, right?
Yeah,
It's not,
it's doable.
it's not gamble. It's you've done the background work. So nice.
Yeah, thank you very much. The only thing I will add is the put I still have. So the put was expired. They both expire August 7th, and I spent about $200 on the put, and I spent about $300 on the call, and ended up cashing out the call for a $400 profit.
Nice.
And now I have the put. It would have gained slightly, but like you said, it still has the Ivy crush on the put as well. So I have until the 7th of August to see if maybe I can squeeze some life out of the put, perhaps.
There's still a chance. And see, I think that's also another tip we haven't mentioned, making sure that your expiry dates give more time for your trades to work out.
Yes.
Either
That's
whatever
important.
direction you're doing and whatever trade. So, I mean, August 7 is still sort of a couple of weeks, wiggle for the trade to work out. So that's a good trade.
Yeah. Thank you very much. Even if it does go to zero, as you said, it could go to zero, and then I would still be up on the trade. Because of the risk management and the sizing. Worst case scenario would be that $200 goes to zero. But net on net, like you said, net on net, it adds up. It's a profitable trade.
And then because you've spread it out, right, you can watch it and you can decide, you know what?
Yeah.
Within a week, you can say, if it's going to go to zero, I won't wait for it to go to zero, right?
Yes. I'll just take it. I'll just take whatever little. Sometimes there's a little something left in it, and I'll just take it off the sheets.
Absolutely.
And look for the next one, because earnings season does heat up. We can have a look at the calendar a little bit later.
All right.
But let's move on to the next question, which is you talked a bit about managing your shares. So you kind of covered this already, but I wanted to flesh it out a little bit. So you have a portfolio of shares that you already hold. Can you walk us through the shares you want to sell and what strategy that is exactly?
Yeah, for sure. I mean, clearly one of the things that you want to be in profit, right? So it's essentially, classic covered call strategy. Often it might be that your shares are underwater. These are not the ones, particularly if they're good fundamental stocks. You really don't want to be selling covered call below your cost basis. So I think what is good for the earnings season is that people sit down, I would say at least a week before the very first company starts to report, and they go through every stock in their portfolio and look at how, what is the cost basis for that stock, as in what is the average price that you've acquired that stock. Then also look at what is the current price and then the expected move, and then make a decision as to if you think there's enough premium. So you can look at the options chain and say, is there enough premium that is worth my while to sell a covered call and get this shares called away above my average price, and then make a bid. So there's a lot of research. So if you've got sort of 15, 20 stocks in a portfolio, that research could literally take you a week going through it thoroughly. So I don't want people to just sort of think it's just 1 hour, have a look what's doing, and you're done. If you really want to do it properly and you really want to make sure that you are selling covered calls on the right stock, then I think that's what to do. So going through your portfolio, it's just the grunge of going through everything you have and making a decision on everything. So that's what I do, and that's what I also advise people to do.
Thank you for sharing. And also, I two things come to mind straight away, is that this is a job. And I think in order to be successful in it, you need to treat it as a job. If it's a hobby, then that's a different story. But if you're looking to gain consistent profits from this, it is a job, and it should be given that attention. The second thing is, I think it's a good segue.
You in on the secret. All the people out there who say, "Oh, 15 minutes a day is all it takes, and then you can go to the beach." I don't know. I am very, very unsure about that.
Yeah, me too. I've never experienced that myself. I would rather put in the work and reap the benefits. So when you were speaking about looking ahead and being a few steps ahead, I don't know if you play chess, but it's nice to kind of play the game ahead, 2, 3, 4 moves, and similarly 2, 3, 4, 5 weeks ahead could really benefit you. So this week here, I think the big announcement today would probably be GE Aerospace and also Netflix. I mean, like you mentioned, TSM reported over there in are they in Korea? No, they're not in Korea.
Taiwan, isn't it?
Taiwan, so, that's it. Of course.
It was kind of 6 a.m. this morning our time. We got the hit, I think it was. So.
It looked like it was really good earnings. It looked like they beat on all metrics from what I saw.
Yeah, they did. Stock didn't move as much, but again, some things are overextended already. But I haven't looked into the detail, but the alert that beat on EPS and revenue, and so that was good.
Yeah, just a reminder to anyone who is watching, if you are sending us live messages, this is being pre-recorded. It's Thursday, the 16th of July, 2026, and it's currently 9:13 in the morning. So if anything does happen between now and the time this airs, we are not privy to any sort of market changes. Just putting that out there. But the last thing would be just having a look at all these different companies that are announcing earnings. And just as you said, if you own some of these companies and they're already sitting in your portfolio, then I think it's prudent to, at the very least, be aware of when they are announcing earnings. You don't necessarily have to trade them, but I think it would be good for you to at least be prepared for some volatility and potentially some announcements after their earnings announcements. So just wanted to mention this is a very important aspect, and it comes off the back of you saying, being prepared not just a few hours or a few minutes before earnings.
Yeah, and earnings happen before you've taken a breath after the last one. You're already preparing for the next one. It seems like a continuous circle, doesn't it?
Yes, it does. And I like the earnings season because there's always something to do. It gives you another potential income stream.
Yeah.
Where non-earnings season tends to be a little bit more focused on, the traditional trades, the normal trades as we spoke about earlier. Yeah. But I guess it's just another little tool in the toolbox that you only use 4 times a year.
It is. And patience is a good thing in trading, right? And for an options trader, sometimes how earnings season behave in terms of maybe some shares drop.
Yes.
It's good to wait 3 months to buy your shares. So if something is overextended and you think, you know what, and you're really feeling the FOMO, then look forward to earnings season and say, you know what, I'll just wait 3 months. Let's see if, the earnings season provides opportunities, and then I'll go. So it also helps you psychologically wait for a period for either selling existing shares or buying new shares.
Yes, and I think that's important as well. I'm glad you added that. We are coming up to time. We're at the 30-minute mark, and the HR team has told us that YouTube algorithm likes videos to be 30 minutes or less. So if we can kind of fast forward, and we can always bring you back on again. But one thing I wanted to touch on before we do wrap it up is common mistakes. So if we take a step back and we look at what mistakes would you flag for traders in earnings season? We covered some of them, but what would be some of your advice or suggestions?
Yeah, I think one of the things is people are not monitoring the timing enough. I think we spoke on the IV crush and the sizing, but one thing people don't really focus on is on the timing of the report. So when is the report coming out? What are analysts saying before the report comes out? And how are you making your trades based on, is it an hour before the report comes out or after? So timing is quite a key thing. And of course, liquidity, the volume of trading goes up. So there's much more liquidity, which traders love liquidity. So monitoring these two. I mentioned about sizing down, be selective as well. I think people feel the FOMO, even after all we've said, Mandela, there's nothing wrong with people saying, you know what, I just want to sit out this entire earnings season. I'm just going to see how things move. I'm going to learn from it. I'm going to see how my portfolio reacts. But for this earnings season, I'm not going to take any trades. That's also good. I think maybe we shouldn't sort of say you have to take a trade. You take the opportunity when you're ready and prepared. If you're not ready and prepared, then it's valid to sit things out. Because as we said earlier, capital preservation is the number one rule in trading. So I think these are some of the things that people have to be aware of. Having cash. So sometimes you might have a portfolio where you want to shore up cash. That takes a while, right? You have to close some trades, look at it again. That could take anything from 4 weeks to 6 weeks. So if in preparing for earnings season, part of the strategy is to make sure you have enough cash in your portfolio and you're not fully allocated prior to earnings season. It's both a risk management and an opportunity tool. So risk management in the sense that, if things go south, you're not over leveraged and you're not going to get your account blown or anything like that. And if they go well, then you can take advantage. So these are some of the little things that I think some traders miss, but people should really be aware of.
Yes, and thank you for kind of bringing it full circle and bringing it almost out of the lecture hall into the trading desk, into the real world for people. Because the one thing that you said that really resonated with me as well is, you don't necessarily have to trade every earnings. I would actually encourage you not to trade every earnings. And if some of this stuff is foreign to you, especially if you've never traded options before or you've never traded these strategies, I would suggest maybe using this earnings season as a research sort of sandbox and forward testing it, and maybe doing potentially some simulated trading or some paper trading, because the last thing you want to do is watch our conversation and then today's earnings try and jump into something, because you don't want to miss out. So no, you hit the nail on the head there, Saheed. And I think also it's very, very good.
About knowing when not to trade, right? We always say it's not about what trade, but it's also important knowing when not to. So that's key too.
Yes. And I feel like that is maybe one of the hardest things to do, because you can always just blindly press a button, and it's the inaction, I think, that is for me anyway,
For
is
me
one of the
too.
hardest things. Yeah, it's one of the hardest.
Yeah.
Yeah. You don't want to miss it. You don't want to miss out. So you think, okay, well, let me try. Let me. Yeah. So it's a very, very important reminder that cash is a position. And people should remember that. All right, so I think that's it for today. We will put the contact details for Saheed in the bottom. Do you want to just remind people who haven't seen your first episode, what's the best way to contact you?
You can get me on my email. My personal email is s_adegbite@hotmail.com. So s_ my surname @hotmail.com. Or just put my name in LinkedIn, connect with me. Happy to connect with people out there and answer questions, etc. So look forward to reaching out.
Thank you very much. And I'm going to put your name up there again so that everybody can see it. If they'd like to connect with you, you have a very active LinkedIn. So it's a pleasure to be linked with you. And any final thoughts, any final words that you want to leave our viewers with today?
Enjoy it. Earnings season is fun, right? I mean, it's also, apart from the trading side, it's a great way to know what's happening in the economy, in the world, in geopolitics. When you get engrossed in earnings season, you get a feel of the global economy, and it's quite important. So once you start to, it's quite fun seeing how things interact with each other, how companies make money. So in all of this, the last thing I'd say is don't forget to enjoy the season. It's like a show. It's just like the Mandela Show, right? It's fun to watch and participate. So just enjoy.
Thank you very much. You're very kind, and you can come back. You can come back on the show anytime with that attitude, with that response. Yeah, we love having you on. We love having you on so much that we had to bring you back on immediately after your last one. So, Saheed, it's a pleasure to speak with you again, and thank you for spending the time to walk us through different ways to trade earnings season, and it's extremely timely. We're right at almost at the cusp of the kickoff of earnings season. So it's a great time to do this. So thank you again, and I'll say it again. We will have you back on the show.
And I look forward to it as always. I look forward to it.
Thank you, Saheed. Take care.
Take care. Bye all.
Bye. What an amazing guest. Really, really a pleasure speaking with Saheed. I had the privilege of speaking with him in person not too long ago, and we were talking about earnings, and he's the type of person that makes it happen. We talked about doing an earnings episode, and the next thing I know, I have a slide deck and notes in my in my WhatsApp almost immediately. So really great pleasure and a privilege to have Saheed with us. But that's it from us today. So we are traveling at the moment. So when you're watching this is going to be pre-recorded, but that doesn't mean that you can't smash the like button. And it also doesn't mean that you cannot participate in the comment section. So please make sure that you subscribe and you connect with us. It helps to keep these shows coming each and every week. And from all of us here at Signature FX, on behalf of our sponsors, City Traders Imperium, I want to say thank you very much for watching. And until next time, enjoy earnings season and happy trading.